So good afternoon, everybody. Thank you for joining us today. Today we're going to be talking about lots of things on the market, demand and supply related. Before we get started, a little bit of housekeeping. So this session is being recorded, and we will basically send out a recording of today's session along with the slides in the coming days. In terms of questions, if you do have any questions, you'll find my contact details at the end of the presentation. So I would urge anyone with questions to get in touch. Similarly, if you have any requirements surrounding data, do feel free to reach out. I'm also pleased to say that we are being joined today by Anthony Hart, who's a partner for student housing at Allsop. Anthony will, at the end of this presentation, run through various market transactions and talk about market sentiments, and I'm sure he's got lots of interesting things to say. So to get started, what we will first start to look at in today's session is demand, and in particular how things have changed as we've entered the new letting season. So the Q1 2022 period which we're referring to is actually referring to October to December at the end of last year. And this really started or marked the start of the 2022 letting cycle. And what we can see from figure 1 on the right hand side is how demand for unit mixes or sizes changed over that period. So changed between the end of last year and the beginning of this new letting cycle. So we can see in Q4, for example, that most searches on StuRents.com were for smaller sizes. So we're looking at studios, 1 beds and 2 beds, for example. And that's really aligned with the fact that international students were house hunting later in the season and were typically going for those smaller sizes. Obviously, as we've entered the Q1 2022 period, that demand has shifted pretty dramatically. And you can see on the chart in figure 1 that in that period, most searches being performed on the platform were for 4 beds, 5 beds and 6 beds. Now that really reflects the fact that most domestic students are house hunting relatively early, or very early in some cases in the letting cycle, and are obviously looking for typically your larger clusters or HMOs. In terms of what this means for the market, obviously for operators of PBSA, having an understanding of seasonality can be very important, particularly when it comes to things like marketing strategies. So referring back to figure 1, for example, if you have either clusters or HMOs, you obviously really need to have those ready and available to be booked as early as October. Similarly, if you are looking to attract domestic students, and really this is applicable to both PBSA and HMOs, given the fact students are house hunting in groups and are looking for larger sizes, the ability to accommodate group bookings is obviously very important. A couple of other interesting points to note over the last quarter. So something that we have looked at as well is how budgets change over the course of the season. And what we saw is that in Q4, or last year in Q4, the average budget that is being set by students when they're house hunting on the platform was about 8.4% higher than in Q1. And what that basically shows us is that as the season progresses, the average budget increases. Obviously, that is partly due to the fact that more internationals are searching later in the season. But again, that can be an important consideration if you are marketing properties. And obviously, if you have some kind of dynamic pricing strategy in place, you may want to adjust that pricing depending on demand at any point of time in the season. Lastly, what we can also see in figure 2, we've just picked Durham in this particular example just to give a little bit of an insight. But what we can see from that particular heat map in this example is really where those inquiries are located. And we can see the various hotspots there. Obviously for Durham, and given the fact we are still relatively early in the house hunting process, that's really going to be aligned to the HMO market. But what is interesting to note there is as the season progresses, what you will start to see is those hotspots change over time and obviously start to reflect the fact that more inquiries are taking place for PBSA as an example. Moving on to talk a little bit more about demand for HMOs and PBSA. and how that is developing this year versus last year. We'll start with the HMO sector, and also we'll come to PBSA shortly. So figure 3 is highlighting two things. It's highlighting the seasonality of the sector, and you can see how inquiries are distributed over the course of a season. But it also shows inquiry growth year on year. And what you can really quickly see from that chart, and it's something that we have presented on previous sessions, is how demand has been very, very robust for HMOs. A very important consideration in that is that HMO demand throughout the pandemic has been really strong. So it's not the case like it is in the PBSA sector, which we'll come to shortly, where the year-on-year comparisons are skewed essentially. If we look at inquiry growth generally, again, year to date for HMOs, we're looking at about 28% growth year on year in inquiries for HMOs. So again, really positive and a really strong sign that the HMO market is really buoyant this year. Another important consideration is the seasonality. We can see from figure 3 that really peak demand for HMOs is around the November period. We've obviously surpassed that in terms of where we are today. So I think that gives us some confidence that the HMO market is very strong this year, and we would expect that to continue the rest of the season as well. Moving on to PBSA. So figure 4 again, we're looking at here is seasonality of PBSA inquiries, as well as that year-on-year growth. And what we can see from that particular chart was that for last year, the PBSA market was very late, and you can see that the majority of all inquiries for PBSA were August and September, really, last year. Positively, what we've seen so far in terms of inquiries is that demand for PBSA is certainly recovering, and we can see that from the chart, the fact that the white lines for every month so far have been well above that of last year. However, as we've kind of touched on, we're really comparing that to a low base. I think we're all pretty aware that last year the PBSA sector was definitely impacted by COVID, and that caused the season to be particularly late. So any year-on-year comparisons that we're making so far are going to be skewed. Having said that, they are up significantly. So we can see from October to January, inquiries for PBSA were up about 153% year on year. So a very large year-on-year increase, again, albeit that was skewed by a low base from last year. Looking forward, again, unlike the HMO market, the PBSA sector is typically a lot later in terms of its peak, and therefore we'll need to really see how that peak plays out later in the season to determine whether this year's been a success for PBSA or not. Having said that, again, early signs are positive, so I suspect it's going to be a very positive year compared to last year in particular. Moving on, so in the last couple of weeks, HESA and UCAS released their latest data. We'll start off with some of the headline stats, and then what we'll actually do is we'll dig into a bit more detail and pick out some individual universities to see how they are performing. Figure 5 shows the year-on-year growth in full-time students by domicile, and the latest HESA data goes up to obviously 2020. So obviously a little bit frustrating, it's always such a delay, but that obviously is the latest data. But positively, we can see that UK full-time students were up 7.2% year on year, so a really big increase. If we compare that to last year, there was only a 1.5% growth. So I think what that shows us is that despite all the headwinds surrounding the pandemic, there is clearly a strong desire from domestic students to get into higher education, and obviously that's reflected in the numbers. In terms of EU numbers, those were still positive, so up by 4.2% year on year. Obviously 2020 numbers were not yet impacted by Brexit and the loss of home fee status. We will see that in a minute when we start to look at the UCAS data, but going forward we probably would expect to see some declines there. In terms of non-EU students, which is obviously an important demographic for the PBSA sector in particular, growth was still very strong. So we saw a 9.9% increase year on year. But it is noteworthy the fact that pace of growth was down considerably. So in 2019, we saw year-on-year growth of 16.1%. Obviously, the pandemic would have impacted these numbers. I think continued restrictions around travel at that time, as well as uncertainty around COVID, will have essentially had an impact on those year-on-year numbers. Broadly, though, other trends that are worth mentioning. So there is this still flight to quality trend that is playing out in the sector. Again, that's something we'll see in a bit more detail when we look at the UCAS numbers. But what we actually recently saw, I think it was last week, was an announcement from government that they will actually be lowering the grade boundaries for 2022. They're taking that approach really to reflect the fact that education has been disrupted over the last few years. But we expect that to play into the hands of these higher tariff providers, at least for that particular year. But I don't see that trend in the long term changing either. One other trend that is worth spending a couple of minutes on is one that is cited quite often in the sector, and this is the rise in 18-year-olds going forward. So we can see from figure 6, we have plotted that rise in 18-year-old population versus the number of full-time UK undergraduates. And really we're coming out of that demographic dip. So what we would expect to see going forward is very strong domestic demand growth. Now, again, this data point gets cited a lot in the industry, particularly around the PBSA market and how it is positive for that sector. And while certainly growing demand is going to be positive for the industry as a whole, really what we would expect there is HMOs to be the big beneficiary of that trend. Most second and third year domestic students will be looking to book HMO accommodation rather than PBSA. Obviously, price is a key consideration there. But that could well mean that we're going to see increasing HMO rents going forward. Now, that's not to say the PBSA sector won't benefit from that. It obviously will, but really it comes down to individual locations. So something that we've touched on before in our presentations is the difference in pricing between HMOs and PBSA. And in locations where that spread is particularly narrow, then obviously there is an argument that increasing domestic demand will spill over into the PBSA sector. Whereas in locations where the PBSA market is particularly expensive relative to HMOs, obviously that argument is a lot less positive and hard to make. So in terms of how that plays out, it is really going to depend on individual locations, I believe. Taking a bit more of a detailed look, what we've actually done on this slide is looked at some individual universities. And what we're really doing here is reiterating the fact that whilst headline numbers are very interesting and grab the headlines, really each location needs to be looked at on its own merit. And each location does, let's say, have a very different outlook depending on what city or university you're considering. So figure 7, for example, what we have done here is we have looked at non-EU full-time student growth over a particular period, and this is between 2012 and 2020. And we've picked out a variety of universities just to really highlight this point. So if we pick out, for example, University of Glasgow, what we're essentially saying there was that in 2020, there was a 205% increase in non-EU full-time students relative to 2012. UWE Bristol was also very, very positive, 192% increase, whereas somewhere like Cardiff Metropolitan, those numbers are still down 41% compared to 2012. Similarly, University College Birmingham, there were essentially 48% fewer non-EU full-time students in 2020 versus 2012. So really that just highlights the fact that long-term performance between institutions does vary significantly. Finally, on the HESA data, so we've also picked out a few interesting stats here around year-on-year growth by country of origin. Obviously, Chinese students are very, very important for the PBSA sector. So it's really positive to see that those numbers are still increasing. And we saw a 2.2% increase year-on-year in Chinese full-term students. But really the standout performer is Indian student growth. So what we saw for 2020 is almost a 50% rise year-on-year in, again, full-time Indian students, which equates to about 26,000 students. So a massive jump compared to the previous year. Something that we have touched on in previous sessions is price sensitivity of Indian students. And whilst there obviously will be some affluent Indian students that will benefit the PBSA sector, I think that's less of a given compared to Chinese students, and that's something to bear in mind as well. Moving on to the latest UCAS data, what we're doing here is we're looking at acceptances. So rather than considering applications or applicants, we were actually looking at those that were accepted. And I think most were probably surprised by the fact that we saw a 1.5% year-on-year decline in total acceptances in 2021. I think, again, most were probably expecting some negativity around EU numbers. We mentioned previously, EU students have obviously lost their home fee status, but the decline there was very, very dramatic. We saw 50.4% reduction year-on-year in those numbers, and that's why we saw total acceptances decline. In terms of non-EU acceptance growth, again, it was still positive at 2.4% year-on-year, but that was down substantially compared to 2020. Again, COVID is going to have impacted those numbers, so I think it's going to be very interesting to see what the next year or two shows us in terms of acceptances from non-EU students. Going back to the points made earlier in terms of this collapse in EU numbers, what we've really seen is that that has impacted some universities more than others. So figure 10, we've highlighted a number of institutions there that recorded a decline in total acceptances. And what we have done is we compared that to the decline in EU acceptances. And essentially all of those universities were dragged down by this collapse in EU numbers. So if we look at something like University of Warwick, for example, total acceptances declined by 370 year-on-year, but EU numbers were down by 375. So that decline in the total was entirely attributed to the decline in EU numbers. That's very similar for Northumbria University. So we have minus 305 versus minus 430. And the same again for University of Dundee in this example, which saw a decline of 130 in the total number and a decline of 205 in acceptances from EU students. Looking at the longer term trends using the UCAS data, again, what we've tried to do here is just highlight a few different universities. And what we're doing is comparing year-on-year growth versus growth over the longer term. And that's reflected in figure 11. Again, we've isolated non-EU acceptances to keep it relevant or most relevant to the PBSA sector. But just to kind of walk through a couple of different universities and how that differs in terms of short-term versus long-term. We saw Nottingham Trent, for example, which has been, there's obviously been a lot of interest in Nottingham from a planning and investment standpoint. But what we actually saw was non-EU acceptances decline by just over 18% year-on-year. Having said that, if you look over the longer term, there were still 307% more non-EU acceptances in 2021 versus 2012. So a significant increase over the long term. That's also the same for the University of Birmingham. You can see those numbers there as well. And at the University of Glasgow, that university did actually record a slight increase year-on-year. But again, over the longer term, it has recorded significant growth in acceptances from non-EU students. Broadly speaking, again, going back to the trend that I mentioned a few slides ago, higher tariff providers continue to outperform. So we can see over the longer term, if we're talking about total acceptances at higher tariff universities, they're up 43.3% versus 2012. If we compare that to the national figure, so nationally over that same period, there has been growth of 20.9%. So what you can quite clearly see from those numbers is that higher tariff providers have outperformed, whereas medium and lower tariff providers have underperformed versus the market. In terms of non-EU acceptance growth over the long term, and again, looking at a similar trend by analysing that by tariff provider, figure 12 really highlights that point. And figure 12 is showing us on an indexed basis, growth in non-EU acceptances by tariff provider. And quite clearly what you can see there is that higher tariff providers have really run away from the market in terms of growth. And in 2021, there were almost 14,000 more non-EU acceptances than in 2012. Obviously, for medium providers and lower providers, you're looking at 1,300 and just over 3,000 respectively. Moving on to look at PBSA growth, what we have done here is we have analysed the number of new PBSA developments that were delivered in time for the 2021-22 season. That's reflected in figure 13. Again, we've just highlighted some particular university towns and cities, obviously not all of them, and we can see from that chart not only the growth in terms of beds, but also the growth in terms of percentage. And Brighton really was, again, the location that saw the largest percentage increase year on year, which was just over 20%. Lincoln and Swansea also recorded significant growth in PBSA supply year on year of almost 16% and 12% respectively. What we can then look at is how that may change going forward. So figure 14 is now considering how PBSA supply may change given the number of applications or developments in the pipeline. And what we can see there is that if all the developments in the pipeline are delivered in a location such as Swansea, then PBSA supply could grow by almost 40%, which is obviously very significant. In Bristol, that is also almost 40%, and in Nottingham, we're looking at around 38%. Nottingham does actually have the largest pipeline in terms of bed numbers outside of London, but on a percentage growth basis, Swansea is obviously slightly higher. It is worth noting not all of those developments are likely to be delivered, so figure 14 can really be seen as almost a worst case scenario. Obviously, cost pressures and other factors will mean that some of those developments probably won't come to market. But something that's certainly worth considering, and we obviously speak to a wide range of stakeholders in the market when it comes to data, is trying to really understand if a market can absorb that additional supply. Now, we would argue that when you're considering whether the market can take additional PBSA, it's not relevant to actually consider total demand in that location. And really, the sector needs to look at the granularity of the data. Typically, example of that is that most domestic students, for example, are not going to be able to afford PBSA, and therefore it's not relevant to look at total demand in a given location. And really what users of the data need to do is look at what is the addressable market for that particular scheme or development to really understand whether that is viable or not. Going back to HMOs, and again, this is something that we've touched on previous sessions, if you're considering private accommodation, so excluding university stock, HMOs equate to about 70% of all stock in the market, which is obviously very significant. And as I said, the ability for a location to absorb supply will depend on things like what's the price of the underlying HMO market. Again, if that HMO market is particularly expensive, then there is an argument that you could attract domestic students out of HMOs and into PBSA, but that's not going to be relevant to suggest you can do that for all schemes or in all locations. Just a few updates on the supply pipeline and how that has developed over the last quarter. So what we saw in Q1 2022 was around 4,300 beds put forward and around 6,500 that were granted planning permission. It's worth noting that is still down by historical standards. So if we look back at the same period last year, for example, in Q1 2021, there were around 20,000 beds that were put forward and around 11,000 that were approved. So saying again that we have discussed before, but certainly the amount of applications in terms of beds that are being put forward is down by historical standards. But again, that does vary significantly per location. And as we've touched on before, somewhere like Nottingham has seen significant planning application activity. Figure 15 kind of shows that quarter on quarter changes to the pipeline across a number of locations. So what we saw in the likes of Exeter and Glasgow was a significant increase in the pipeline there, albeit from a relatively low base. So we saw in Exeter around 600 beds being put forward and a similar amount in Glasgow. And those equated to about a 41% increase in the pipeline and a 56% increase in the pipeline for Glasgow. London actually saw a significant number of beds, so just over 1,300, but in percentage terms was relatively low in terms of a change to the previous quarter. On this slide, we've just picked out some of the larger schemes that were either submitted or approved. So we can see that in the last quarter, there were a couple of schemes that close to 700 beds put forward in Exeter and Glasgow, and also significant schemes in Leeds and Nottingham as well. In terms of those that were approved, in Bristol, we saw a very large 837 bed scheme granted planning permission. In Nottingham, we can see almost a 700 bed scheme, and in Portsmouth and Birmingham, again, some very substantial developments that were approved. If we look at the total pipeline nationally, obviously this excludes those that were delivered for 2021. We're looking at a pipeline nationally of about 103,000 beds, and around 72,000 of those have now been granted planning permission. So I think at this stage, what I will do is I will hand over to Ant to go through various market transactions. And yeah, Anthony, over to you.
Thanks, Richard. In the next 7 minutes or so, what I thought I would do is outline where general market sentiment is for PBSA and HMOs before looking at some transactional points of interest and what they might tell us of the sort of short-term outlook. Starting with HMOs, I think most landlords were themselves pretty surprised how well the asset class performed throughout the pandemic. Most of our clients were able to collect 90+% of contracted rent, and the booking periods for 21-22, 22-23, as reflected in Richard's data, have for some been the strongest on record. Despite what some commentators have said, in that typical HMO tenants are now preferring a move to ensuite and studio accommodation for security purposes and other reasons, I actually think the pandemic highlighted the strength of the student demand for HMO living, and for investors, the robust nature of the asset class. I think we've now got more nationally present, well-capitalised HMO investors than I've ever known, seeking portfolios of traditional houses alongside some small conversions and smaller blocks of PBSA. In some instances, however, it is true to say that landlord aspirations do not quite align with the target returns of some of these investors. Challenges with HMO ownership and HMO deals do persist, relating mostly to planning and compliance. Article 4s have heightened planning due diligence, with particular importance now placed on historic use and associated licensing, while at the same time, local authorities are increasing their surveillance of the sector, bringing forward new minimum standards for matters such as room sizes, communal space, and fire safety. What complicates these transactions somewhat is the inconsistencies that we find between different local authorities. For PBSA, I said in a recent Q4 review that I wrote for Allsop that so far as investors were concerned, this was clearly the moment the PBSA sector returned to its full pre-pandemic appeal. The reason I said that was because of the level of competition that we were witnessing, particularly for core assets offering scale. But to be honest, even for assets that perhaps sit outside of that criteria, as I will highlight shortly. There is, at present, an unprecedented level of unspent capital. The reasons why PBSA remains so popular amongst investors are too well documented, and I won't regurgitate. The long and short is that growing student population requires more beds. But one point that I think is often overlooked is the fact that the growth of student numbers can no longer really be absorbed by HMOs. Planning restrictions will limit and in some areas completely curtail any growth in HMO bed numbers. So if anything, the need for more PBSA will likely benefit from this over time. It is not all to say that PBSA hasn't been and isn't without its challenges. In a few instances, there are examples of COVID and non-COVID related occupancy issues. Much of this pain is falling onto older stock in secondary locations where rents have sort of outstripped quality. So in instances where students aren't really finding value for money. The spotlight is also on external facades and internal configurations, both issues relating to fire safety. This again is most prominent in older buildings, but in some newly delivered too. An invasive sort of inspection report into the external facades of buildings is becoming a bit of a standard piece of due diligence. This is what we're seeing in the market at the moment, often highlighting sort of remediation to achieve a B1 or higher EWS1 rating. The B1 rating seems to be the bare minimum expectation for investors. Just turning now to look at transactions, it is sort of notable in comparative terms that very little is said or written about HMO portfolio deals, but that's not necessarily to say they're not happening. The private nature of the landlords often mean the preference is for the details of sales to be kept away from the public domain. So disappointingly, sorry, but in the absence of real examples, I've provided some rough yield guidance on the slide here. This does need to be treated with an element of caution in its application, because what actually happens in reality is buyers will analyse yield based on their own experience of OPEX and also based on their own rental assumptions. So quite often as a result of that, yields to the landlord look stronger or sometimes weaker than those set out here. Average bed values are probably somewhere between 50 and 100k currently, with naturally some anomalies. Fortunately, the PBSA market is generally far more transparent, so it is easier to provide some examples, for which, to be honest, there are far too many to list here, even throughout the last 3 months. You know, there's been so many deals, transactions that I'm sure you've seen reported. So what I've done is I've picked out some very recent, in most instances yet to be publicised transactions or sales with some relative points of interest. So pictured on that last slide, you'll have seen the Union building in Coventry. What really caught my attention here was sort of a big asset, 500 beds in Coventry, and recently got under offer maybe a week or so ago. My understanding is this sale will probably reflect a yield of sort of sub 5.5%, and that there was competitive bidding for this asset. For me, it's very rare that Coventry features on a target sort of list of cities for investors. So I'm sort of wondering what this is telling us about the market currently. The other interesting portfolio sale was the Triumph portfolio, which is 620 studio beds, comprising Dresme Court in Durham, which I think was pitched on the last slide, Stanley Studios in Southampton, and Westgate in Exeter. It took my interest, not least because demand has taken the bidding way beyond the £84 million asking price, but because the constituent parts are relatively small in PBSA terms, being under 300 beds. It is quite common for smaller assets to struggle, but clearly the quality and overall quantum supports a price which will be getting on to sort of 5% on the nose. The sales process for Havana House, which is pictured on this slide in Glasgow, is of interest to me because it acts as a good barometer between pre and post-pandemic yields. On initial launch in 2019, late 2019, this may have achieved or was on track to achieve circa 5.5%. It was withdrawn from the market in early 2020, relaunched, and is, I think, about to be announced, achieved sort of a yield of 5.25%. So you see some real yield compression there. And finally, Capital House, which is pictured, and the Fitzallen in Cardiff are two transactions what I think are worth highlighting, mainly because they are predominantly formed of office conversions. Capital House is a recently launched 420 bed scheme in Southampton. The asking price reflects 5.6%. I think they're going to do better by the sounds of it, roughly 5.5%. And the Fitzallen in Cardiff, 350 beds, recently closed, subject to loads of interest, showing a yield of around 5.25%. Just thinking ahead and thinking about trends and outlook, alongside further sort of well-documented completions in Q3 and Q4, pre-pandemic yields have definitely strengthened, particularly for core assets with scale. Some of the opportunities I have highlighted just now also suggest investor criteria is broadening, perhaps as a result of high levels of competition and a lack of available stock. We think yields have definitely compressed 25 basis points and will do further, but perhaps not across the board. While secondary cities are beginning to get some investor attention, the yield gap between highest tariff university cities has definitely widened and shows no signs of closing at the moment. For HMOs, I don't see yield shift as a result of demand because current investor strategies don't really afford for this. I do, however, see value growth in the short term by virtue of significant potential for rental growth, which again aligns with Richard's data from earlier. Thank you very much, Richard.
Thanks, Ants. Really interesting stuff. That concludes today's session. As I said, if anyone does have any questions on any of the data or wants to discuss any potential requirements they may have, do please reach out. Again, we will be presenting or sharing this slide and recording after the call as well. So just leaves me to say thank you all for joining and enjoy the rest of your afternoon. Take care.